Okay, so we're going to kind of split the way we're going to go. The videos I'm going to be posting, the one I'm posting today is about the loans, and the ones that I also assigned today from Khan Academy are going to begin the home buying process. So I know it's very interesting to a lot of people. So we're going to start with actually how much you can afford. Should you buy or should you rent? And is it always a good time to buy? Is it always a good time to rent? So some good videos up on Khan Academy for that. I'm going to shift towards the ones I'm going to post. Going to shift more towards investment side of things. Again, what we should be working on outside of the videos is going to be our final project script if you haven't submitted it already, and your final project. I'm going to be putting a survey out that asks you which platform you're going to be using because I need to figure out the best way to collect and view all your projects. All right, so let's get to work. We're going to be talking about consumer loans. And one of the first type of loans you could get is an installment loan. An installment loan is going to be a fixed price. Okay, so uh, generally, if you purchase something like from a furniture store where it's buy now and don't pay any interest until 2022, those would typically be an installment loan. So as long as you um, purchased, you can't add to the balance now. So that was that fixed price, and that was the purchase price. And then you have a certain amount of time to pay that loan back. Now, the what I just quoted you is an interest free, where no interest will start to accrue until after that certain date. But in others, they're structured as this is a 3 year. You have 3 years to pay me back plus 5% interest. Okay, so these are this is money that's borrowed for a specific period of time, and all this will be agreed upon first. Now, personal loans. A personal loan is a very expensive loan because it's based entirely on your credit worthiness. Okay. So they're going to really delve into. They're going to take a look at your three C's of credit. They're going to look at your FICO score and delve a lot through your report. If it's an unsecured loan, it's going to be very expensive. Okay. So when you apply for these, you have to have a very defined purpose. Okay. They're going to examine your credit history, any existing debts, any current payments to other creditors, um, going through your monthly and yearly income. Plus, they're going to want to know what kind of job security you have. All right. So personal loans are very risky since the lender, since they're unsecured. So they'll carry a much higher interest rate. So even the most creditworthy people are paying at least prime rate. Okay. And many others would be paying a lot higher than that. You can lower the rate by adding collateral um, or adding a cosigner. Okay. And that would lessen the risk to the lender. Now, secured loans are a pledge of property. Okay. And that's collateral. Now, this lowers the risk to the lender because there's something of value that they can take in exchange for a default. Okay. So, since the loan is secured with property, it will carry a lower rate of interest. Your auto loans and your home loans are self collateralized. Okay. So, if I don't pay my auto loan back, they will repossess my car. If I don't pay my mortgage back, they'll foreclose on the house, and the bank will own the property again. Like I said before, a cosigner could be used if you don't have anything of value, but then that puts the co-signer's property on the hook at times. Um, Now, that's causing a lot of problems in the student loan arena where parents are co-signing and the student doesn't finish their college degree. Okay, we'll talk a little bit more about that in a later video, hopefully. And let's finish with home loans. So this is a very short video since I assigned Khan Academy as well. Um, I'm going to assign some Khan Academy videos too, so they'll go into more depth on some of these things, like the balloon, the arm, a hybrid, things like that. Um, the one I'm going to steer you guys to is the fixed. Okay, the fixed The rate is fixed. It won't change. So you know exactly what you're going to pay for the next 15, 20, 30 years, depending on what you agree to. I always go with the 30-year fixed because what inflation does to the value of the payment is the $2,000 in year one might be seem very expensive, but $2,000 a month in year 30, the inflation has eroded the value of those $2,000, and over those 30 years, your income should have risen substantially. But the way they're structured, you can also repay early. You are going to pay a lot of interest over those 30 years, but you can shorten the term if you attack it the right way. And I'll explain that in a later video. All right, so let's go into some of the mortgage types. Again, mortgage being come from the French origin, meaning death pledge. Okay. I'm going to avoid the morbid nature of that. But balloon, it's a monthly payment. The monthly payments are very low because you're basically just paying the interest. You're not paying any principal back. Okay. And because of this, at the very end of the term, whatever you borrowed, the lump sum payment needs to be paid back at the end. Now, the reason that the payments, if your payments are low and you're only paying interest, what you're supposed to be doing is putting money aside because there should be more room in your budget in order to put it into an account, and then eventually towards the end of the term you can pay back that lump sum total. If you're not very good at budgeting, this is a horrible mortgage for you. Many times these exotics, I refer to them exotics, are really not for homeowners. They're really for people that are looking to flip the property and don't want to own it for a very long time, or know that they're going to be they're on a job for 2 years, so they're going to be in the area, and then they're going to be moving in another 2 years. So those would be situations where I'd consider one of these. But if I was buying with the idea that I was raising my family for the next 30 years, I would not be in any of these two exotics. ARMs were a big problem during the financial crisis. It's an adjustable rate mortgage. So they will adjust as interest rates go up. Your monthly payment will go up as interest rates go down. Yours could theoretically go down as well. But an ARM is split into two phases. So where it says like a 1.5 or 1.7, it might be the first 5 years are at a very low rate where you're only paying interest back. Okay. And then after that window closes, you'll adjust to the much higher rate. Okay. So these are kind of like teaser rates in credit cards. Once they expire, okay, you go back up to the normal payment level. Okay. And again, you're not building equity in the property if you're only paying interest. If you're not paying any principal, we're not gaining any ownership of the property. So whoever loaned you the money still owns it. Okay. Now, this was these, again, going back to the ARMs in 2008 and 2009, that crisis, when these ARMs expired and they ratcheted up to the much higher payment, some people couldn't handle that adjustment. One, because they didn't think they were going to still be living in the property. They thought they were going to be able to sell it. And when they realized they couldn't, then they realized they couldn't pay the much higher interest rate. And you saw a rash of foreclosures that rippled through the market. Now, in a fixed interest rate is fixed for life. Okay, so once you agree to it for the next 15, 20, 30 years, that's exactly what you're going to be paying. When you know exactly what you're going to be paying for the next 30 years, it's very easy to work that into your budget. Okay. Now, the 15-year, the monthly payments are going to be higher, but you'll own your home in 15 years. Okay. The mortgage rate, or excuse me, the mortgage payments for 30-year is it's going to be lower, a little bit more manageable, but it takes me 30 years for me to finally buy my property back from the bank. Now, your payment is split into part interest and part principal. So in the early phases, you're going to be, if you were paying, let's say, $2,000 a month for that. If you were paying $2,000 per month, some of that would be broken up into, let's call it, interest would be say 1,700. Okay, and principal would be like a measly $300. So in that first payment, when I send that first check for $2,000, $1,700 is just going back to pay principal, interest on the loan that I took out. $300 is going to go to principal, but that means I own $300 more. I have $300 more equity in my property. Okay. In the next month, you're going to see, and I'm going to keep the numbers round. I'm not going to change. You might have this much will go to interest and $101 goes to principal. Now you're going to have 360 payments, and you're going to get something called an amortization table, which actually details in every mortgage payment how much is going to interest and how much is going to principal. Towards the year 29 and year 30, this will flip, and you'll only be paying $300 in interest and $1,700 in principal. So you can see that the amount of your property that you or the amount of equity that you have in your home starts to really grow towards the later years in the loan. Okay, so with this being a little bit more manageable, I know you're paying a lot of interest. What you can do is send additional payments each month. So in this, if this was payment number one, this was payment number one in my loan. Send them one check in the first month for $2,000 for payment number one. But if this is payment number two, I can send them two checks during this time, one for $2,000 for this payment, and then a second check. And in the memo, I'd put principal payment number two, and I'd write them a check for $301. Okay. If I did something like that, I'm going to shorten the life of my loan by several years. Okay. And I'm going to save myself a bunch of interest. Okay. So this is a technique that you can do rather than some people suggest just sending an extra mortgage payment per year to shorten the life of your loan. It's very difficult to come up with an extra $2,000, but it's easy in the early years to come up with an extra $300. So this is a method that I recommend for shortening the term of your mortgage. But one of the reasons why I don't do it all the time is because this right now is manageable. And this $2,000, 30 years from now, the buying power of $2,000 is going to be halved. So it's almost going to be like having your mortgage payment by letting inflation erode the buying power of the dollar. All right, I'm going to cut that short, let you guys get to the Khan Academy videos. Again, continue working on your scripts if you haven't done so, and continue working on your final project.